Good morning, everyone. Thank you for joining us here this morning. And as you know, just a little while ago this morning, our office released our annual Fiscal Outlook for the state of California. We just, as a note, we're also releasing simultaneously an outlook related to Proposition 98 for education and an outlook related to the Medi-Cal budget. And so just to kind of level set as a reminder, this outlook that we do every year is our office's assessment of the state's budget condition based on our independent forecast of revenues and expenditures. And it's meant to precede the formal start of the budget process when the governor's proposal comes out in January with an estimate of the state's baseline budget condition going into that using a current law and policy basis. So we're not making any assumptions about discretionary policy choices that may be made in the coming months. But that's sort of the basis of this. I wanted to just make a quick note of thanks to our staff. This is really an all hands on deck effort to assemble this analysis. Takes, pretty much everyone in the office has a part in this. I do want to give a special note of thanks to Ann Hollingshead, Carolyn Chu, and Brian Euler. They have done some particular leading roles in putting this together, and so wanted to just acknowledge that. What I would do today is provide a quick assessment of the bottom line, and then tell you about the revenues situation, the cost side of the ledger, before that feed into that bottom line, and then turn to kind of looking ahead to the multi-year period, and then close with what our comments and high-level recommendations for the legislature are on that. So I'll go ahead and jump in here. And I'm going to share some slides because I think it's helpful in telling the story. If let's see, so you can cooperate here with me on the turning of the page. Sure. Not really sure. Oh, maybe we'll work on that here. So let me tell you the bottom line. The bottom line is that for the upcoming budget year, 2026-27, we are estimating an $18 billion budget problem or deficit for that year. And this is a $5 billion increase from the $13 billion problem that was estimated back at the time of, back in June when the Budget Act was passed. This is really the fourth consecutive year now where the state is facing budget deficits. And, you'll kind of note this as a theme throughout that we think this points to some structural issues within the state's overall budget that the legislature may, need to keep in mind as we go ahead. As I turn to kind of the revenue picture, here we go. I was just going to start with kind of the economic setting for the revenues. And basically, both at the national and state level, the economies are facing some headwinds at this time. The national economy continues to face high borrowing costs. There's a pretty low consumer sentiment readings out there. And then we have the situation created by the federal policies related to tariffs and other policies that are adding to uncertainty in the overall economic situation. Then when we narrow in a little bit more on California, what we see is pretty lackluster, broader economic performance with basically no net payroll job growth this whole year, resulting in or related to that, being fairly flat taxable sales, which then, of course, translates to weaker sales tax trends and weaker corporation tax trends. However, there is a source of strength that is performing quite well out there, and that's our personal income tax, which has shown a lot of strength, actually. It's up double digits this year. And the best we can tell, this really does reflect the very strong exuberance or enthusiasm around AI and the investments going on there. This is helping propel the stock market to very strong performance. The S&P 500 is up over 50% over the past 2 years. And much of these gains are really being driven by the handful of AI firms and AI adjacent firms, which are all making billions of dollars of investments in the data centers and extending very extraordinary compensation packages to some of their key employees. And of course, this does benefit the state's bottom line. I mean, a lot of this activity is flowing into the state in the form of personal income tax revenues. But the question becomes, it's really a fairly crucial question. How sustainable are these trends? And, I think one of the key messages that you'll see in our report is that we think it's risky to assume that these trends will just continue unabated. I think we've all heard the old adage that this time is different, and certainly that may be the case. But as we've looked through various market indicators and measures of how the stock market is doing, there are certain things that are lining up in a way similar to how they have in the past when they've preceded a market downturn. So certain measures of stock valuations, PE ratios, and variance of that, as well as the extent to which investors are buying stock or equities on margin, basically borrowing to buy stocks. That's quite elevated at this time. Also, just even the sheer exposure of households across the country to the stock market is higher than it's been in 70 years. And, this type of alignment in these various indicators, like I said, has tended to occur 1 or 2 years before there's been a downturn in the market in previous times. So that's sort of the risk that we're identifying and trying to formally incorporate into our forecast this year. And so how do we do that? Well, in our revenues, I'd like to start just by noting that despite all of the risks I've talked about, our revenues through the budget window, which goes through 2026-27, are actually 11 billion higher than they were at the time of the Budget Act. And this does reflect the enthusiasm around the AI investments and all of that. However, if we were to just extrapolate from the recent cash collections that we've seen coming into the state and the stock market performance over the past year, our revenue forecast would be much higher than what we're showing, much higher than this 11 billion upgrade. And so instead of that, what we're showing, and it's on this figure, is a temporary upgrade to revenues, and that reflects this positive activity that I'm mentioning before the revenues then subside to falling in line with what the assumption was back at the time of the June Budget Act. And that kind of more subdued performance in the future months is what reflects our belief that some of the market activity is getting a little bit overdone at this point in time. I do want to be clear about this. Our office is not predicting a market downturn. And if we were predicting that, or we were assuming that in the forecast, our revenues would be much lower. I mean, tens of billions lower than what we're showing. But at the same time, if the market just continues the trajectory it's been on throughout the year of going up that way as strongly as it has, well, then if that happens, there's a good chance the actual revenues will beat our forecast. But even if that were to occur, our view would be that the legislature should treat that as more of a temporary or unsustainable type of situation. So I guess, this kind of begs the question, if revenues are up by $11 billion, why does the state's deficit go from 13 billion to 18 billion in our forecast? And of course, the answer to that has to do with the cost side of the budget. And there are two big buckets that I'll mention. The first is our constitutional funding requirements. So when we have higher revenues, many of you are familiar with Proposition 98. Proposition 98, with the higher revenues, requires us to take 7 billion of that 11 billion in higher revenue and direct it toward our schools and community colleges. Similarly, Proposition 2, our rainy day fund measure, constitutional provision requires us to take 3.4 billion of the higher revenue and direct it to our reserve and to paying on some of the state's debt. And so right there, you're really 10.5 billion or so of the 11 billion is accounted for. But then apart from those constitutional requirements, our office also estimates that costs across the rest of state government are also higher than what was previously estimated by the administration by almost $6 billion. The largest of that is just in this category we describe as statewide expenditures. This includes things like retiree benefits and just general state administrative expenses. I'll also draw your attention to H.R. 1. That's the federal, so-called One Big Beautiful Bill. We estimate that adds about 1.3 billion in cost to the general fund in 2026-27. Around $1 billion of that is in Medi-Cal, and 300 million of it is in CalFresh in our estimates. So with that, you can see, this is a total of about 16 billion of additional expenditures, and we have 11 billion in higher revenue. The gap there is this 5 billion in additional cost. You add that to the 13 billion that we were estimating back in June, and you get to the 18 billion estimated deficit that we show here. Just at a high level, that's sort of how you get to that number. Okay, so then turning to the multi-year, looking ahead, we always look 3 years into the ahead after the upcoming budget year. And here, the state's structural deficits actually worsen. We're estimating about $35 billion per year in structural deficit. So, you can see what we're showing on this figure is just that this estimate in the teal colored bars is larger than the recent structural deficits that we had estimated in prior fiscal outlooks. And so, that paints somewhat of a daunting picture, of course. And there are two high-level explanations for why this is happening. And it goes back to 2022-23. The state experienced a fairly precipitous drop-off in revenues that year. And the state assumed in its budgets that the revenues would begin to recover after that. And although revenues have increased and the stock market has gone up, the revenue recovery has not quite returned to the level that was assumed by the state back then. And then secondly, our state expenditures have not been realigned to this lower revenue base. And so those two factors result in this structural deficit. And that's even after this past summer, in the legislature, where they took action to reduce some ongoing expenditures, particularly in the Medi-Cal program. So this is after factoring in those effects. This is the picture that we see. Just to give a little bit of additional specific information about this, some of what is challenging the budget structure is the fact that some of the one-time solutions that the state has used in recent years to address the deficit problems are beginning to expire. Things like the employee furlough programs. So as those expire, the full costs come back online and weigh on the budget structure. In addition, or similarly, in recent years, the state is engaged in higher level of budgetary borrowing to help address deficits. So borrowing from special funds and shifting costs back. And, there's some planned repayments of that borrowing, and that's reflected in these numbers as well. In addition, some state programs continue the course of rolling out expansions. This includes things like added childcare slots and foster care. Foster care rate reform is the other one. And so some of those programs continue to roll out and add to cost. And then finally, one I would mention is that the H.R. 1 federal bill, by the time you reach 2029-30, the final year of our forecast, that's adding about $5 billion in annual expense to the state budget. And so the kind of budget structure issue that we're identifying in the outlook is that by the end of the outlook period, revenues and expenditures are growing at a similar rate. And so that reflects some of the changes that have been made especially in the most recent budget, where the legislature did make some ongoing reductions. So it's good that the growth rate of expenditures and revenues are coming back into alignment. But the problem is there's nothing in place to bridge the gap between the level of revenues and expenditures. And so that kind of leaves us with this ongoing structural problem. And so that's one of the key messages about the multi-year period, which takes us to more, what our comments are about the budget situation, which first is just kind of a sobering reflection that, frankly, the budget condition right now has become relatively weak. We face a somewhat sizable deficit problem in 2026, 27, and worse problems after that. And just, to remember that this is happening in the context of a, economy that's not in recession, when the stock market has been going up and when revenues have been growing. And so that is what helps underscore to us the fact that there is a structural problem in the way that, the budget expenditures and revenues are aligned. Adding to that, the state's budgetary resilience has been diminished in recent years. A lot of the reductions that have been made, especially before this most recent budget cycle, a lot of the reductions were one-time in nature. And, we've drawn down on our budget reserves. We've increased budgetary borrowing. And on the revenue side, while we have increased revenues in certain areas, it's been done on a temporary basis. And so at this point, our budget reserves are going to be down to around $14 billion in total, which is good. It is good that we have that level of reserve, and we think that's important, but it is about half of the level that we had going into this deficit cycle. The budgetary borrowing has increased to over 20 billion. It's around 22 billion now. And so that will continue to weigh on the general fund in the future years. And as we look at the range of one-time options, the borrowing and shifting around, the menu of those options becomes attenuated after the state has done that for multiple years in a row. And so that's also a factor to keep in mind. And it really informs our high-level recommendation for the legislature, which is to consider making ongoing adjustments to the budget. So, some combination of ongoing spending reductions and ongoing revenue increases is what is called for at this time. And I'll just, I can stop sharing at this point, but I'll just note, certainly we have continued to try to stress the fact that the revenue forecast is always hard to predict. Revenues are hard to predict in California, and certainly the revenue forecast is uncertain. And it's definitely possible that the revenues could beat our forecast, particularly, as I said, if the market continues to do well. However, I would just point out, if we have $30 to $35 billion in annual deficits, we need a lot more than that in revenue in order to grow ourselves out of this problem. Normally in a typical year, our constitutional requirements take up about 50 cents of every dollar of additional revenue that we get. So that means in order to close a $30 billion deficit, just through additional higher than expected revenue, you'd really need about 60 billion in annual revenue higher than what we forecast. And I think our view is just that that's highly unlikely to occur, especially through the multi-year period. And so that's really what underpins our recommendation here, that the legislature begin taking more structural and ongoing types of actions to address this deficit. So I will stop there and here with our staff to respond to questions you may have. Mike was going to direct there. Okay, looks like Ashley, you have a question. I don't know if Mike can. There. Great.
Hello, can you hear me?
Yes.
Hi, thank you so much for doing this. My question is, and it just, Mr. Petek and the LAO, you all for the last 4 years have told the legislature, or advised the legislature, I should say, against new spending, against certain actions that they keep taking, and they keep largely avoiding the recommendation that you've made, which is to potentially find some areas in which they could cut spending. I mean, I asked that to ask, I mean, do you feel like you have been unheard for the last 4 years that has reached us to this point of apparently the state having a budgeting problem?
I'll start with a couple of reflections and then maybe some of my colleagues would jump in. It's a really great question. And I think it partly reflects, that a lot of what state government does is providing services to vulnerable populations, to the people of California. And so it's very difficult for the policymakers to, it's not an easy choice to make, essentially. And so, when we had the situation coming out of the pandemic where revenues were surging, actually, and we were benefiting from the influx of federal resources and the stock market was booming, we were in a period where we made a lot of one-time and temporary spending allocations. And so as that fell off and we began having these deficits, part of our recommendations, if you think back on it, was, well, the first thing to do is eliminate that temporary spending and the one-time spending, because you can do that and not cut into these core programs that I was referencing, Medi-Cal and CalWorks, or child welfare and things like that. And they did that. They did that to a significant degree, which now I'm pointing out here. That's not going to be enough, because at this point, a lot of those options have been used, and we're at the point now where the underlying budget structure is what we have, and there isn't a lot of remaining temporary spending on the books to cut back on. And so that's kind of how I see the picture. I don't know if that helps answer the question you have, but
Sure. I mean, I guess just to follow up, I'm just trying to find a way to regurgitate this back in a way. You all do complex work, and I'm just trying to make it easily digestible for folks who, don't understand or watch the budget. But, I just looking at the numbers over the last even 6, 7 years. In May, I asked the governor about, the clear growth in spending. I mean, how much larger our state budgets have become, and he basically chalked that up to California's economy that has grown. And I wonder if you just have that same assessment.
I think our assessment is probably a little bit different. I mean, last year, you may recall in our outlook, we did highlight the fact that the growth rate of state expenditures was exceeding revenues by several percentage points, and that was problematic. And to their credit, the legislature made to their credit, from a fiscal standpoint, the legislature made some difficult choices this past summer, and particularly in the areas of Medi-Cal and reducing some of the ongoing commitment in Medi-Cal. And that really does help, like I was saying during the remarks, it does help bring the growth rate of expenditures and revenues back into closer alignment. We are stuck still, though, however, with the level of revenues being kind of structurally below the level of expenditures, and that's a problem. And I do think, to your point, I think over the years, the costs and expenditures and the commitments of state government did run ahead of what the state's fiscal capacity really was, and so now that is part of the explanation for why we face these fairly large structural deficits in the future years. I don't know if, yeah.
Thank you.
Thank you, Ashley. I don't know.
It's in the order.
Okay, how about Stella? You?
Hey, can you guys hear me?
Yeah.
Hey, thanks. Yeah, I'm with Cal Matters. I guess I have a couple questions if that's okay. One is that can you elaborate on the impact of these temporary fixes that the state has made in past years, namely internal borrowing and shifting costs and drawing down reserves? I mean, what happens if this year that's the path that they go down again?
Well, it's, as I said, we think the range of those options is narrower. They've used up a lot of them at this point, and so there aren't as many available. However, I don't want to make it sound like there are none available. Certainly, I think there could be still some additional options like that. But as for, I don't know if you know like anything more specific on that, Carolyn,
Maybe
or-
I would just offer that utilizing or relying predominantly on temporary solutions in this year would make would under our estimates mean that next year the legislature would need to deal with the full structural deficit of 35 billion. And let's say in a sort of relying on borrowing and reserves, if they did that in this year, it would mean even less to very little of that type of option would be available when a much larger deficit would be facing them. So there are still some of those tempering options that they have. The state probably could do some more internal borrowing, use a few of those tools still. But it would mean there are fewer when the structural deficit is much larger next year. And, under our, attempt to kind of temper expectations about the sustainability of revenues when the state might be in a different economic and fiscal position altogether, because you're talking about really 2 years from now at that point.
Mm-hmm. Yeah, thank you.
Thank you. Sorry, just a follow-up question too. Could you elaborate on the temporary revenue increases that has happened in past years and what those are?
Yeah, I think we're mostly thinking about the suspension of corporations' ability to take net operating losses to reduce their tax liabilities. So when you suspend their ability to do that, it brings in more revenue in the near term for the state. Similarly, the state suspended the ability of the businesses to take certain tax credits. And so likewise, when those are suspended, it brings in more tax revenue for the state in the period while those suspensions are in place.
Gotcha. Thank you.
Thank you. Let's see, Rachel.
Hi, thanks so much. I'm going to ask a question and then I'm going to pass the computer to my colleague over here who also has one. But can we talk a little bit more about what non-temporary solutions would look like? When you're looking at the budget, are there any areas that you think are good targets for reductions? And what would that look like? Yeah, I'm a healthcare reporter. Are we talking about reducing Medi-Cal benefits? Are we talking about reducing enrollment? What are some solutions that we might be seeing?
It's probably not what you want me to say, but we're sort of intentionally stopped short of making specific recommendations here because this is, as I was indicating, this is our initial forecast using current law and policy, trying to describe the landscape for the legislature as they go into the budget process. I mean, ongoing reductions, for example, would mean, cutting programs or services or eligibility or enrollments, as you're saying. And I mean, certainly programs like Medi-Cal is one of the largest spending areas in state government. And so in order to start addressing those large deficits that we're highlighting here, it makes some sense to at least look at some of these programs that are where the state is spending the most of its money. But we didn't really intend for the report to get into that level of advice at this stage of the process. Yeah.
I've got a tech question here for you.
Hi, folks. Tyler Katzenberger with Politico. Regarding artificial intelligence, how much of your forecast for AI is based on vibes, for lack of a better word? I see you point to possible indicators of generalized stock market overexuberance in your report, but what evidence do you have besides historical parallels to point to the fact that the AI industry itself is overvalued, not just the stock market?
I might see if I can throw this to the manager of our economics unit, Brian.
Yeah, hi. Brian Euler, as Gabe mentioned, I manage our econ team. I mean, I think that our assessment really is when Gabe spoke about the overexuberance and the enthusiasm around AI, that really was an assessment about asset prices, really, because in the stock market specifically. And the reason for that is because that has the most direct nexus to our revenue situation. That is really the channel through which what is happening in the AI sector, the most direct channel through which it kind of benefits the state budget. And so really that was the focus of our analysis. I don't think that I would characterize the evidence that we were looking at about the stock market as being vibes based. I think that the kind of historical parallels and the sort of the empirical evidence there is kind of the standard process we use for all of our forecasting, where basically most of the forecasts we're doing are trying to identify historical patterns, and that's kind of the best evidence we have about what is going to happen going forward. And so that's what we did in this instance. We looked at prior periods going back even the past century, when all these sort of metrics were aligned the way they are, and what did that tell us about where the stock market may be going. So that was kind of the focus of the analysis.
Gotcha. Yeah, I'm a believer in history repeating itself, but I'm just wondering, like, is there anything you're seeing from in like hiring trends in the tech and AI sector, or anything else from the sector specifically that might be cause for concern?
It's an interesting question. I don't know that we've necessarily evaluated the staying power of the AI sector specifically for this analysis. But, one thing that is sort of notable is that, the state's information sector, which is where a lot of this sort of tech employment tends to show up in the data, it's really dropped off precipitously since 2022. And it has not recovered over the last year or so with all of the enthusiasm and build out with AI. So in terms of the state's job numbers, overall, our top line, we haven't had any net job growth in the state so far this calendar year. And that's also true in the tech sector. So whatever sort of advances or whatever advances may be happening in that sector, we're not seeing it necessarily in jobs being created on net in the tech sector, at least in California.
Yeah, thank you.
Okay, Casey Murray.
Hi, Casey Murray with Bloomberg Tax. I wanted to ask, I have two questions. The first is, do you guys have any specific recommendations on what you think the legislature should do to increase revenue? Any specific types of taxes or programs they should look at, taxes that could be, used to kind of make up those revenue gains?
Well, I'll probably, kind of give a similar response to the other question, which is just that we stopped short in this report of making specific recommendations like that, again, because we're kind of trying to describe the landscape both on expenditures and revenue side. I anticipate as the budget process begins and is unfolding that the legislature may, be interested in us helping them with analyzing specific options, but we're not really prepared at this time to put forward a recommendation quite as specific as that. Yeah.
Okay. And then on the corporate income and payroll increases kind of lagging behind expectations, do you guys have anything else that you can elaborate on that point? If conditions are expected to change, and yeah, if you're expecting anything different to happen there, or things that can be done to change that.
Yeah, I can speak a little bit to that, to the sort of the corporate profits and taxable sales being sort of lagging. It's difficult to identify. I don't want to necessarily oversimplify it and say there's some singular factors going on, but I think some of the primary things that are driving that on the sales tax side, we definitely see that sort of just generally consumer sentiment and their feelings about the current state of the economy and where the economy is going are sort of historically low, and we do think that is playing into sort of the diminished sort of buying activity that we're seeing. And at least in terms of recent trends, there hasn't been any sign that is necessarily going to reverse in the near term. On the corporate profit side, it's even more sort of a complicated story. However, I think that there are some concerns that certain, recent federal policy changes like the tariff increases have put some pressure on corporate profits. And so that could be part of what is, showing up in some of the recent weakness. And that similarly does not appear to be something that in the near term is reversing.
Got it. Thank you.
Okay, thank you. Sophia?
Hi everyone, Sophia Boleg here from the San Francisco Chronicle. Actually, following up, Brian, on what you were just saying about the tariffs, last year during a lot of his budget presentations, the governor really blamed tariffs for a lot of the budget problems that he and the legislature had to solve for. And I wonder, from your perspective, what actually is the impact of tariffs on the state budget? Is that contributing to this deficit that you guys are projecting?
I think that in general, they are a drag on the economic situation. I think you're right that the administration did have some sort of much more specific estimates about the effect of the tariff policies and when they reduced their May estimates. We don't have any sort of specifics along those lines. And in part, it's a very complicated relationship with the economy, and really the information we have about the effect that it might be having on revenue is sort of by what appears to be effects on sort of indirect measures of things that we look at with revenues. And I'm going to start repeating myself, but things like, kind of consumer sentiment and things like that, where they did appear to react very negatively to the tariff situation. And that could be certainly dragging on the state and national economies. So, I think it is a contributing factor. It's certainly not the only part of the story. And the state's sort of underlying economic weakness certainly precedes the changes in tariff policy. We've sort of been noting for the past couple of outlooks that the state's economy has sort of been lagging. And we tied a lot of that to a different avenue of federal policy, which was more about what the Federal Reserve is doing with increasing borrowing costs and increasing interest rates, which really hits the state in particular because some of our big sectors are really sort of sensitive to those borrowing costs. And so that has already been hitting the state for multiple years. That effect is still there. The recent federal policies probably are not helping that situation.
So just to make sure I'm hearing you correctly, you guys don't have like a specific number that you feel like you can point to, like, oh, the tariffs contributed X amount to the state's budget problem. Is that right?
That's right.
Okay. And then I also wanted to, on another sort of federal related issue, I know in the report you guys talked about HR1 and the impact there, the sort of increased state spending that the state will have to do on Medi-Cal and CalFresh. And I'm just wondering, is that because HR1 requires states to pay more, or is that more like backfilling based on the state's policies that say, here's the threshold, and the federal government has sort of raised their threshold in their policies, and so like the state has to make up that difference? Like, can you guys explain sort of why state costs are going to have to go up on those programs specifically?
Sure. So Carolyn Chu with the LAO. So our estimates of the cost of HR1 are exclusive to the ways in which the bill changes how much the state has to pay in both CalFresh and Medi-Cal. It does not reflect any backfilling of reduced benefits or lower eligibility or anything like this. So the two of the big drivers are, one, the state has to pay for a share of cost of CalFresh benefits. Up until this bill, the federal government paid the full amount of those benefits. So now the state will have a share of cost in the coming years. And then there are a number of different changes happening in Medi-Cal, but two of the big movers are changes in the way the state levies healthcare provider taxes. So like the managed care organization, you remember there's a lot of discussion around that. And then also the state's share of cost for emergency and pregnancy services for immigrant populations. So the state will need to pay a larger share of that cost. There are some offsetting effects because HR 1 imposes the community engagement or work requirements on childless adults. And so we do anticipate disenrollments from that policy, which does reduce state costs to some extent, but on net, those other factors raise the total state costs that the state must contribute, that it's not about policy choices that the legislature could make to backfill those.
And have you guys developed any estimates of what it would cost for the legislature to sort of make up the difference? I'm not saying, given the budget condition, I don't know if they will want to do that, but certainly I think there'll be some lawmakers who are interested in that. Like, do you guys have an estimate of if the threshold weren't raised, like those people who will be kicked off of CalFresh and Medi-Cal, essentially, if the state wanted to continue providing benefits either in food stamps or for healthcare for those people, how much would that cost the state?
We don't have a formal estimate, but it would be billions and billions of dollars. So just as an example, for the childless adults population under the Affordable Care Act, the state only pays 10% of the cost in Medi-Cal. So if the state created a state-only program for those individuals, the state would need to pay the full cost of care for those individuals, and it would far, far exceed the state costs that the state has when those folks can participate in the Medi-Cal program.
Thanks.
Keely Webster.
Okay, so how bad is the wall of debt and in interfund borrowing going on compared to what it was, the amount that was paid off during the Jerry Brown era of the mid-aughts?
Yeah, that's a good question. So back then, I think the wall of debt at that time got up to around $35 billion. And, of course, the budget was smaller than it is now. So in relative terms, we are not at that level. It's more that wall of debt was accumulated as we were coming out of the Great Recession. This wall of debt is being accumulated in the absence of a recession. And, so I guess that's sort of the reason in particular that we're pointing this out. And it has been increasing in the last couple of years. And so, we view that as somewhat cautionary that's been happening.
The other thing, and I know this has been covered a little bit already, but how concerned are you guys about the discussion by economists about the potential for an AI bubble?
Well, I mean, we're quite concerned about that. That's sort of what, we're describing here with our revenue forecast. The revenue forecast that this outlook is premised on factors in the risk of that happening, and the risk of that happening as opposed to it actually being the main assumption are two different things. But the risk of that happening when we put it into our models helps weigh down sort of the lower end. And so again, while revenues are up in the current year, we're forecasting them to slow down and drop off a bit in the budget year because of that risk. And in some ways, our revenue estimate can be thought of sort of like as a little bit of a hedge or an insurance against, if there was a full downturn, like I said earlier, the revenues would be much worse than this. But at the same time, if there is no downturn in the immediate term, then the revenues could easily beat our forecasts. So we're not assuming that either. We're kind of in that middle ground area. But we think, the various indicators that we discuss in this report on, I'd kind of direct you to page 5. We think some of these indicators are really pointing to that risk. And, in empirical terms, as Brian said, these have tended to be the type of indicators that appear, in advance of a market downturn. And we're consciously describing it as a market downturn. That's more severe than a correction, which has sort of a technical definition of a 10% downside move in the stock market. So we're talking about something that's, the risk of something more significant than that, and not just a downward blip that recovers right away. We're talking about a downturn a kind of serious downturn that persists for a while. And so we think that risk is definitely elevated at this time. We can't, predict precisely when it would happen, but we just think the risk of it is higher now than it has been. And so we think it's prudent for the policymakers to factor that into their thinking.
Okay, thanks.
Okay, thank you. Tran?
Hi, yeah, Tran Nguyen with AP. Can you go over in terms of the reserve how healthy it is right now, and what could legislator and the governor could use it for this year? Is there a possibility that they would wipe out the reserve this year? And then looking ahead, where would that put the state is, considering if there's no reform coming?
Yeah, so I mean, the state currently has, oh, sorry, thank you. Ann Hollingshead, with the LAO, of course. So the state currently has about $14 billion in reserves. This is, obviously well below the level that we had kind of going into the series of budget problems when it was closer to, I think it was a bit above 25 billion at that time. So it's, maybe closer to half of that amount. So that is like a pretty impressive level in some ways, given that we're in the fourth year of budget problems and there's still $14 billion remaining. That said, it is only $14 billion. It is less than the $18 billion projected budget problem, and certainly less than the $35 billion ongoing budget problems, which would all be, cumulative with one another. So, I think we would say sort of good and bad. Good that the state still has budget reserves remaining, but challenging that the state faces these problems despite the fact that we're not even, projecting a recession, and certainly, bigger revenue downturns relative to what relative to what we have in our forecast are absolutely possible. And then the state would really need budget reserves. So, I think it's sort of neither a super positive nor a super negative answer.
Thank you.
Yes. John.
Hey, thanks for holding this session. Just have a question about education funding. If you could explain on simple terms why TK-12 and community colleges through Prop 98 will take bigger share than its normal 40%. From your calculations, I think 7 billion out of the 11 billion in additional revenue would go towards Prop 98. I wonder if you could say why that will happen.
Yeah, I think it's always, when it comes to Prop 98 questions, it's safer for me to ask Edgar to help describe that. So,
yes, right. So Edgar Cabral, I'm the manager over our K-12 unit. Hi, John. I will break out the 7 billion into a couple pieces. So first, there's 5.1 billion that I would call formula-related increases in Prop 98, and so that's what's associated with because revenues are higher in 24-25 and 25-26, we have a higher minimum guarantee. In 24-25, the state would be paying maintenance factor, so there's a slightly different share of the additional revenue that goes to schools and community colleges. So combined, it's a little bit more than the 40%. Then the other 1.9 billion. This is not a change because of the formula. This is because of a decision that was made in last year's budget to not fully pay the 24-25 estimated minimum guarantee. There was 1.9 billion in what we call settle up funding that was not provided, with the idea being that at this point, under this next budget, we would see if that obligation was still owed, just in case revenues went down. And then the payment is then required to be made before the state or as part of the state certification of Prop 98 for 24-25. So at this point, revenues are even higher than they were for 24-25 in the June Budget Act. So that payment now is required. So our forecast assumes that payment is made. So that's part of the distinction this year is it's not all just formula related. Some of it is because we're paying that obligation that we kind of assuming budget conditions were going to be at the same or better than what was in June was going to be an obligation this year.
Great, thank you. And follow up on that. There will be federal cuts to education, along with other areas of the budget. But in terms of migrant foster care, lots of different cuts proposed. Has LAO considered maybe encouraging that the state compensate or make up for that loss, either maybe through Prop 98 or elsewhere?
We haven't done like a specific analysis of how exactly the state would go about doing that, but that definitely can be part of budget conversations over the coming year. I think under our outlook for 26-27, we don't have a lot of ongoing funding available. So the story on Prop 98 is because of the higher revenues in 24-25 and 25-26, the state would have about $7.4 billion in additional funding it needs to provide to schools and community colleges. That's all one time though, so it's one-time spending. There'll be lots of one-time spending under our if our assumptions hold. In the budget year, after you account for baseline adjustments and you provide the statutory cost of living adjustment, there's only about $200 million within $100 billion plus Prop 98 budget, right, to cover new commitments. And so on an ongoing basis, there isn't necessarily capacity to fund say if we eliminated migrant or Title III funding or something like that.
Great, thank you, Edgar.
Stella, do you have another question?
Yeah, sorry, I have another question. So one of the things I didn't see in the report is, the most recent federal policy on housing and homelessness. I was wondering if you guys have an idea about how, the Fed's change on housing and homelessness policies could impact the state's fiscal outlook, given that we might see a reduction in housing subsidies coming from the feds.
So I think you're referring to funds that don't hit the state budget directly. So there are a number of areas in which the federal government has taken action that affect federal funds that flow to the state but don't come through the state budget, and the state doesn't have really kind of direct control of their allocation. And so that housing and homelessness and housing subsidies in particular is one of those potential areas. So we don't have a specific. Sorry, this is Carolyn Chu. We don't have a specific estimate of the impact across those variety of funding areas. We've done some work on kind of high-level federal funds earlier last year, but in terms of changes since that time, we don't have a specific estimate because those are not typically funds that flow through the state budget.
Gotcha. But is there a chance that the state, if it wants to and chooses to, could backfill that to ensure that to lower the impact on homeless people in California?
So I think a challenge that the state is going to face is that before even considering backfilling federal funds, the state, under our estimates, needs to solve an $18 billion deficit. And so that requires a combination of spending, revenue, and other solutions to solve. Then the legislature can say, okay, we believe we want to backfill, X or Y or A or B policy or program that the federal government is no longer participating at the same level in. But that requires dollar for dollar additional solutions, so either spending reductions or revenue increases in order to do. And that gets pretty challenging. So that I think will be a particularly difficult conversation for the legislature this year in the context of the changing federal policy landscape.
Gotcha. Thank you.
Okay, I don't see additional hands, so I just want to thank you for your interest in the report, and certainly feel free to reach out to us if you have follow-up questions, and I hope you have a good day. Thank you.